Welcome back to the course Introduction to Commercial Banking and Fintech. And in this course, we have covered almost most of the aspects. Now onwards, I think it is important that we should focus on the regulation. But before discussing the regulation, we must understand what type of risk banks face and what are the challenges and how can we understand. So I thought it is also going to be a very commonsensical for everyone, and I think a lot of doubts that you have in mind will clarify with this lecture. And in this particular session, we'll be focusing on some kind of risk that the banks face, and also we will be talking about the structural fragility. Then we have the non-performing assets, and also based on these indicators, can we also have some idea about early warning signals, which means that can we say that banks which are having high NPAs or at the level of high NPAs, can we say that banks are also moving towards a high solvency? Now, all those angles are going to be touched upon in this particular lecture. So going ahead, let's start. So for this particular lecture, I have referred the book by first. This is the standard book that I've referred so far. It's the Mishkin. Then Saunders is a good book on the financial institutions management. It is also a book which can be read, and it is a widely referred book. Saunders is well known. For micro foundations, if you want, Fraxas and the Rochett both have done a good job, and they have come up with a very good book, Microeconomics of Banking. And if you want to understand the deeper side with theoretical understanding, so this book is very good. Hull we have touched upon for some aspects related to the risk, and the book Risk Management and Financial Institutions are important. Then here we have the Resti A and Cironi to 2007 Risk Management and Shareholders Value in the Banking Valley. For the one caveat, the edition I will have to recorrect, because this looks like we have the book based on the futures and options, but this particular book is based on risk management, so it is also a very good book to refer. Normally Hull is known for options, futures, option and derivatives, and the book is widely popular, but this book is on risk management and financial institutions. And some of the documents which are available and web pages available on the RBI have been very helpful. So I would request that if you are interested, you can go through these two, and this it will help you understand better. Hull part we have only referred toward the risk side, so that I think that can be left out, but Mishkin and Saunders and Frazier are three best references. Now let's understand the structural fragility of banks. What is the meaning? So what is the purpose of the bank? So in a typical definition, how do we define a particular bank? Particular bank can be defined by simply it is an intermediary between depositor and the borrower. Depositor deposits money with the bank. Bank keeps some amount of fractional reserves and lends some the or rest of the amount to the borrower. So in a nutshell, if I have to define that, it means that bank is simply using short term deposits and converting that into a long term loans, which means that I have the depositor and I have the borrower, right? So here is the bank playing. So whatever short or long term, so let's think about the short term deposit. It is being deposited in the bank. Bank is now lending to the borrower by keeping the fractional reserves, right? So this is what we have done in terms of credit creation that we saw a few lectures back, and this is the way the bank does. But is this the simplest way? If this is so simple, then why we have so many bank failures? Why we have so many regulations for measuring the banks failure and bank run and all those cases? So in the last lecture we looked at on the bank run model of Diamond and Debig, and we understood that why banks are the risky businesses, and why banking sector remains most volatile and most structurally vulnerable sector when it comes to risk absorption and even the interconnectedness that we often encounter. So what are the vulnerabilities? If I have to define vulnerabilities, then the first is the high leverage. High leverage in the sense that it may happen that bank is having a lot of liquidity, and a bank is getting a lot of loan requests. So in excess reserves, bank has kept a huge amount of money, but a time comes when there is a huge demand for loan coming, so bank does not keep sufficient excess reserve, or you can say working capital. But a news comes about some board of management failure or some manipulation. As a result, there is a huge request for redemption of the deposits and withdrawals. As a result, we may have a situation. So high leverage in the sense that you are leveraging on the deposits of the depositors, but what happens if the depositors are going to withdraw that amount? So high leverage is considered in that way. Leverage can also be on the borrower side, because of the agency theory that you can apply with adverse selection and moral hazard, the bank is going to or bank has given a loan to a borrower which is not a good borrower, a bad borrower. So it means that given the details that the borrower has revealed, based on that you have leverage and given the loan, but it looks like it is going to be tricky. So high leverage can be have both understanding. Liquidity mismatch in the sense that you have taken the deposit for more than 1 year, suppose for 2 years deposits, and then you are going to lend to the people, or the borrower may have the demand for suppose more than 10 years, or maybe in some cases less than 1 year too. So that could be one of the challenges that the banks face. But liquidity mismatch basically deals with the maturity, that when the maturity is going to come, and within that period if you are not having sufficient liquidity to pay back, then this creates a big trouble for the bank. We have seen in case of IL&FS crisis that when we had a NBFC crisis back in 2018, it was in towards the late 2018. At that time, some of the financial institutions declined to honor the redemption of the investor in their bonds because they were having no money. So liquidity mismatch may also happen for that reason, because you did not foresee the risk coming, and then you have gone for a normal business. You have to make sure that you should have the sufficient liquidity, otherwise it may create trouble. In the case of central bank, we also see in terms of the operation twist, which is an unconventional measure, but in that also we see that you have you can say central bank does change the short term and long term yield curve, and because of that they are able to take those the operational twist kind of measures. Then the last one comes. So liquidity mismatch is all about that. Last one is very crucial, and it is some kind of recent trend which has been found. It was done earlier also, but because of the invention of internet, network connectivity, and also majority of the digital transactions taking place, as we saw in the case of SVB, that how digital transactions created a solvency problem for the bank, and bank had to go for bankruptcy because within a minute billions of dollars were transferred from one account to another, and the bank found it helpless. So interconnectedness matter, because nowadays institutions are connected with the network, maybe the transactional network that they have, and in case of any kind of a shock coming in, or the trouble in one financial institutions can have the spread or a spillover effect on another or different types of institutions that may create a case of systemic risk. So we call it as systemic risk. So in the case of finance it is called systematic, but we in the case of banking we call it as systemic. Why systemic? Because it is related to the overall system. So once so it may happen that suppose State Bank of India, which is the largest bank, it is facing an issue with the liquidity mismatch, and this, if it comes out, then it will have a lot of a backward and forward linkage effect on the banking sector. As a result, we may see a major decline in the asset value of the major banks, and then there is further trouble, and this may create a big shocker to the overall. And if the central bank does not react on time, then it may lead to the systemic failures, overall failure of the banking system, the collapse or pessimistic dominance rather than optimistic, and people may not have that much confidence in the banking system, and they might be moving away. So which could be called as the process of disintermediation. So this is what we often mention. So risk cannot be made zero, but it can be minimized. So with that perspective, risk management, it helps in ensuring solvency and systemic stability, and these are the important angles. Especially 2007-8 global financial crisis, we have seen that there has been a surge in understanding the banking risk management, and especially Basel norms coming, Basel II and Basel III especially. We have found that majority of the banking system is now aligned with some kind of global banking governing standards, basically to avoid this type of issue that we have, systemic instability and also the insolvency. Then we have also looked from the last lecture that the learning was that we did with the Diamond-Dybvig 1983 model, in that what they found that when the depositors face idiosyncratic liquidity shock, which means that due to the banking system shock, it may be because some manipulation, some default happens. So we discussed the case of PMC, that how DHFL lending was the major shocker for the investors, which means that it was particularly to the bank. Idiosyncratic liquidity shock means bank specific shock, particular shock linked to the bank. Banks provide liquidity insurance through demand deposits, right, and loans are long term and illiquid, that we know. So what was the case in the case of the Diamond-Dybvig model, that there was coordination failure. The person who is standing in the queue first and the person who is not going to, so person who is allowing to mature and person who is not allowing to mature, which means they're going for early withdrawal, there was some kind of coordination failure, because the person too who was allowing to mature and getting the R, rate of return on the deposits, feels that if he is late, then he may not be getting the exact return. And this is what we saw, right, that how banks were selling assets at a very substandard rate, and as a result the return for 1 rupee deposit in the bank, the person who went early or stand in the queue had 1:1. The person who reached late, he had the return of, if I was investing in 1 rupee or depositing 1 rupee in the bank, he received only around 0.86, if I am right or so. And this was the case, that 86 paisa and rest of the amount was the loss. So this, I believe others will withdraw and I should withdraw too. So this was the gist of what we saw in the case of Diamond-Dybvig, the coordination failure. And we also saw that we saw good equilibrium where there is no liquidity issue and everyone feels that let's earn whatever the bank gives, and based on the bank model they are all satisfied. A run equilibrium happens when panic and any mass withdrawal creates trouble, and those who are allowing or those who are confident about the banking firm or bank, they are also now in a hurry to withdraw money, and as a result the bank run happens, right. So panic causes mass withdrawals, so that we saw. Forced asset sales, this we saw that it was sold on discount, right. So bank did not get the fair price. As a result, the rest of the people, those who did not withdraw at the first go, now they will be given at a less price. So insolvency happened with the bank, which means that the banking system requires a confidence, and confidence becomes the state variable in banking. So Diamond-Dybvig model, we also saw that it is linked with the risk spread and at a very micro level, and it also deals with the idiosyncratic kind of setup, wherein bank specific risk is considered, not the macro and other factors, right. So why bank needs to be regulated and why we need the risk management. So here we have a lot of agency theory application that we have already seen. One is the adverse selection, which means that as we saw, we have good borrower and bad borrower. So if you have the bad borrowers are more willing to accept high rates, so this could be adverse selection example. Raising rates may worsen borrower quality, which means that a good borrower may not be interested in borrowing and he look for alternative. So higher R, riskier pool, higher default probability, right? So this is what we look at. Moral hazard ex post. So adverse selection is the ex ante. Moral hazard is ex post. Borrowers may take hidden risk after receiving funds, right? So this is what we are. So in the case of social security, especially the pay as you go, so social security models are quite popular. So pay as you go, and then you have the mandatory savings, right? So in mandatory saving, this is also one of the reasons of moral hazard, that sometime pension authority may be investing in some of the risky investments. As a result, they may not be giving that much return, but attracting a lot of risk. In the same way, the banks, for example, SBI may lend to some firm which are politically connected, and they may not be able to pay on time, and bank will be feeling helpless, and as a result, they may be going for the evergreening of account. So that we have already discussed that what is that evergreening account. So that those kind of thing we can touch upon. So borrowers may take hidden risk after receiving funds. Bank managers may increase risk due to limited viability. And why risk governance matters, because you have already deployment of technology for screening and monitoring, collaterals and covenants that we have discussed already, and the concentration limits, that how much is the market concentrated in the banking sector. Now there are theoretical angles attached. So we touched upon two angles, Daman Devig and also the risk side. From accounting based indicators, if you look at their balance sheet, and can we get the measures that helps us derive from the balance sheet metrics, which are linked with the maturity transformation, leverage and information asymmetry. So asset quality, we have GNPA, net NPA, slippage ratio, loss absorption. Here we have the provision coverage ratio. All these things we'll be discussing. I may not be able to recall everything. So CET ratio, which is linked with the Basel 3, CAR, which is linked with Basel 2, the adequacy ratio, liquidity coverage ratio, that here we have liquidity buffers, and then here we have the NSFR that we'll be discussing in a few moments, linked with the Basel 3. These indicators, what they basically measure, that how stress, the banking stress that we see, how it can be materialized. So this is what we often look at. And what we have in terms of the market based indicators and integrated risk management. So there are indicators which are like exposed kind of, wherein the banks are declaring the NPAs, but we don't have idea. Had it been known earlier, we would have reacted to it, but banks are declaring after. So that becomes a challenge. So what we are looking at here is that whether the market based indicators, so for example, market indicators could be the equity return volatility. So if the banking sector is not giving you good return, so that you can apply through some kind of time varying volatility models here, right? So one is the standard deviation that you can calculate always. Another is the volatility measure. So here you can do like for example, on a time varying volatility could be calculated through Garch model. So you can take Garch 1 so generalized autoregressive conditional heterostochastic model. It was given by Boller's law. So what you can do is that you can take the banking sector. Suppose here we have in India a BankX index, right? So this index represents the major banks, right? So what you can do is that you can take the returns. So I take the returns of this index. So I have the price given, right, whatever is the time period. I go for a return calculation. So I calculate the return, right? So I have now here I going to go by log PT upon PT minus 1 and multiplied by 100. Let me write down clearly. I am writing compounded returns, continuously compounded return. It is continuously. If you want, you can multiply by 100. So this is what I am getting. So I have the return. So what I can do is that I can write the regression RT is equal to alpha 0 plus alpha 1 r t minus 1 plus epsilon t, and now I can take the standard deviation of variance of this, so I can write here sigma square epsilon t is equal to alpha 0 plus alpha 1. I can go on taking the square of this and write here epsilon t minus 1, and then take the lag of this, do the instrumentation. So I can do that sigma square epsilon t minus 1 plus, you don't have to put anything here, you can just go on. Now I can go for, so if you want you can also add here some error term, and you can extract the residual and see whether it is stationary or not, right? You can think about its moments, because it is heteroscedasty, so better to touch upon the kurtosis and the skewness kind of third and fourth moment, and see whether which is the appropriateness or fit of the model. But you can extract this particular value, which is the volatility, right? So this you can multiply that by sigma square et that you have, and if you want to see overall aggregate annualized setup, so you can multiply by root sigma square 2, and this will be like root, and then it will be sigma t. Or else you can just extract this sigma square epsilon t and plot it, and if you plot over a period of time, so this will be your sigma t, and this will be your sigma square t, and this will be your time period, and then you can see that whether over a period of time in which period it was higher, it was lower, it may go like this, right? So this we can see that what went wrong, that this particular period is experiencing high volatility, right? So this can be measured in this way. Bond yield spread, low maturity bond to yield spread. CDS, why I have written here if available, because so here you have credit default swap, which is not easily available in case of India. We don't have such product, swapping of the credit default. So credit default swap, so sometime in first world countries available, so that's why I have written if available. Then distance to default is one measure that we will be discussing later, that how it is, whether the banks are near to the default frontier or far from default frontier. If it is far from default frontier, it is good. If near, it means that the default is likely, right? So that kind of a structural model we'll be discussing, and may add some more understanding about it. So how much spread is anticipated, so this is what we get here. So integrated risk assessment principle is this. So here we have the realized risk, which is the accounting, then here we have the expected risk, which is the market, and then here we have the comprehensive stability view, which means that if I have to think about how much it is coming from accounting side, then expected it we can see about how much it is coming from the market side. We can also calculate the VIX of the all banking stocks, the volatility implied index coming from the options market. So this is also a forward looking indicator called the fear index kind of. We can also get the sense of it, and then we can have both accounting and markets. So then we can see that whether the comprehensive stability view is so which means that, so here it means that we'll have to think about all these indicators, then only it is possible, otherwise it will not. Now if I have to get into the banking risk that we often say, so what is the banking risk? So first is the credit risk that we often say, another is the liquidity risk. We'll be getting into each and every details in further lectures, and we have the capital risk, market risk, operational risk is somewhere that may not be relevant, but we'll be touching upon operational risk also, right? So now let's go about the bank risk, the taxonomy of the bank risk. So which means that bank risk refers to probability that a bank's income may bank's income, capital or liquidity will be adversely affected by internal external, which means that it is linked with either the credit, which is linked with the loan, liquidity mismatch kind of, solvency, which means that whether it is related to the bank's insolvency, bankruptcy, market risk, which is linked with the market that we discuss, and operational. So this is what we have, how much we have, and stress we can calculate. So liquidity stress, if you just take the difference of these two, so this will be telling you the liquidity stress, that how it works. So a credit default risk, if I have to calculate, so how and in what way we can say, which means that probability that the borrowers fail to meet contractual obligation if they are not paying on time, right? So could be like corporate default, retail delinquencies where they are not able to repay, sectoral concentration, if the particular bank is giving loans to only a particular sector, then it means that if that sector is not doing good, then it will create a lot of trouble. Then macroeconomic downturn, which is related with the systematic risk, that if the systematic risk is not GDP, inflation, other indicators are no. So all these indicators are linked. And finally, we get into the capital adequacy ratio kind of, which is the regulatory capital upon risk weighted asset, and what it implies we can also get as we go for calculation later for Basel 1, Basel 2. So as we get along the other indicators, we will be starting in the next lecture from here, credit risk and the capital risk, and then we'll try to touch upon. So far what, let me summarize. So far what we have discussed is that can we measure the risk and bank fragility with these different set of indicators, what all indicators we need, and do we have sufficient information about that. All these things lead to ultimately highlighting the role of the banking sector risk management, and we are touching upon these things. I hope this lecture has been helpful, and I really appreciate, and in the next lecture we will be continuing further. So I really appreciate your attention, and I hope you are enjoying the course. Thank you so much. Thanks for your attention.